Okay, this is going to be an example of interperiod tax allocation for a brand new company looking at its first 2 years of operation. I am not a tax guy, so I am certain at some point I will misstate the tax law or use a tax term inappropriately. I apologize for that in advance. But at this point, we are financial accountants trying to have our income statement and our balance sheet correctly reflect our current and deferred tax liability. So we're not learning about how to prepare income taxes, but we're learning how to have our income statement and our balance sheet be correct. And what makes it so hard is that our financial books are going to look different than our tax books. Our income before taxes is going to be one number, but our counterpart taxable income on our tax return is going to be different, which means we're going to have a different income taxes number here on our income statement than our income taxes payable. That's the check our tax preparer tells us to write. Why do we have different numbers? There are permanent differences. So if we own, for example, some municipal bonds, when we receive interest on those, that certainly revenue shows up on our books, but it does not show up as taxable income on our tax return. Interest received on municipal bonds is tax exempt. There are temporary differences, the most common of which is accelerated depreciation. So on our tax return, we're going to record a whole bunch of depreciation expense in the early years of an asset's life, and we're probably going to use straight line on our books. So by booking a lot of depreciation early, we're deferring taxes until later when we get caught up or reverse out that difference between accelerated depreciation and straight line. So let's look at the facts for this example. It's the first year of business for this company. They do business on the installment contract basis. In other words, they get paid by their customers over time. Since it's highly probable that they're going to get paid on their income statement, they get to book $560,000 worth of gross profit from those installment sales. Remember, if it wasn't likely that they were going to get paid, in fact, if it were unlikely, we'd use the installment sale method of accounting for these profits. But in this instance, we assume that they know they're going to get paid. Well, that's accrual accounting, whereas the tax return preparations process requires cash accounting. And so we'll book $112,000 of gross profit in each of the next 4 years. So we'll book the cash that we get this year that gives us this $112,000 of gross profit. That'll show up on our tax return. But the 4 future years where we get $112,000 of gross profit won't hit our tax return until those years. So we're deferring taxes on those. That's a deferred tax liability. Another deferred tax liability is our depreciation expense. For income statement purposes, we use straight line. For our tax return, we use accelerated depreciation. It's all going to reverse itself out in the end of the day, but we are in fact deferring taxes by taking a bunch of depreciation expense in the early years. We also have a tax asset, a deferred tax asset. We sell our stuff and we warrant it for 2 years. For our first year of operation, we estimated $200,000 of warranty expense. So on our books, as good accrual accountants, we debited warranty expense for $200,000 and credited estimated warranty liability for $200,000. In point of fact, we only spent $44,000 fixing our stuff for customers during 2013. IRS won't let us take a deduction for all $200,000 that we estimate. Since we're on the cash basis on our tax return, we'll only get a tax deduction for that $44,000, and we'll postpone the remaining $156,000 of tax deductions until we actually make those cash expenses. There's 2 permanent differences between our tax return and our income statement. There's municipal bond interest we've already talked about, so that shows up on our income statement but not on our tax return as revenue. And we have, conversely, a deduction that's going to show up as a deduction from income on our income statement, but not as a deduction on our tax return. That's relative to fines and penalties. So the IRS won't let us deduct money when we break the law. All right, pre-tax income is $412,000 for 2013, and the tax rates are 50% this year and 40% going forward. So all our deferred tax assets and all our deferred tax liabilities are going to be valued using this 40% rate, because that's when they're going to reverse themselves out and hit our books. All right, here goes nothing. Let's look at our installment sales first. We had $560,000 worth of installment sales. So since we're pretty sure we're going to get paid, we booked all $560,000 worth of the gross profit from those sales on our books. But the tax return is prepared using the cash basis, so we'll book $112,000 this year because we received the accounts receivable cash that allowed us to earn $112,000 this year, and each of the next 4 years we'll book the balance. So what we've done is we've deferred $560 minus $112,000 that's on our tax return. We've deferred $448,000 worth of gross profit to be taxed in later years, and it's all going to reverse itself out because we end up with the same total. It's just a temporary or timing difference. Same thing with depreciation expense. On our book, for example, this first year we booked $90,000 because we're using straight line. But on our tax return, we used modified accelerated cost recovery system, so we're booking a lot more depreciation expense in the early years and less in the later years. So this first year, the difference between our book depreciation expense and our tax depreciation expense is $18,000. It will all reverse itself out, of course, because total we'll book $540,000 worth of depreciation expense on our books and on our tax return. But in the early years, this deferred tax liability is building up and then going down. So both these guys, even though one is revenue and one is expense, they're both deferred tax liabilities because later on we're going to have to be paying more taxes. We have a deferred tax asset on the warranty expense. So on our books we debited warranty expense for $200,000, credited estimated warranty liability for $200,000. But the IRS won't let us take a deduction for estimated warranty expense. They don't trust us. So we only get to take a tax deduction for our actual warranty expense incurred during the year, which is $44,000, which means we've got $156,000 that we're going to be able to deduct later on when we actually make those warranty payments to our customers or incur those warranty expenses for our customers. We've got a permanent difference of $28,000. We've talked about that already. On our income statement, we booked $28,000 worth of interest revenue, but it is not taxable, so that never shows up on our tax return. Similarly, we broke the law and had to pay a penalty of $26,000. That's going to show up on our books as a deduction to arrive at income before taxes, but it will not show up on our tax return to arrive at taxable income. Book tells us that we have $412,000 showing as income before taxes on our income statement. So now let's see what our taxable income for this year should be. First of all, we'll take into account the permanent difference of $28,000 that showed up on our income statement, but not on our tax return. So we're going to subtract that from our income before taxes. Conversely, this $26,000 for penalties and fines, we deducted it on our income statement, but we can't deduct it on our tax return, so we have to add that back in. Those are the two permanent differences. We have two timing differences. We've got $448,000 worth of revenue in the form of gross profit that we're going to recognize in the later years, not this year. We've got depreciation expense of $18,000, the difference between what we booked on our books and what we booked on our tax return. And we've got this warranty expense, which is our deferred tax asset of $156,000. We booked $200,000 on our tax return, but only $44,000 on our, $200,000 on our income statement, but only $44,000 on our tax return. So we have $156,000 worth of deductions we can use in the future to reduce our income tax bill. So that means our taxable income for 2013 is $100,000. So we figured out that we're going to credit income taxes payable for $50,000. That's $100,000 times our 50% rate is $50,000. But now we have to figure out what our balance should be in our deferred tax liability and our deferred tax asset account. So let's do the asset first. So we've got $156,000 of deductions we're going to get to use in the future. In the future, our tax rate is going to be 40%. So the balance in our deferred tax asset account should be 40% of $156,000. To get it there, we're going to have to, since it started with zero, to get it to that balance, we're going to have to debit deferred tax asset for $62,400. What about our tax liability? Well, that guy has to keep track of these two items here. So we're going to take 40% of $448,000 and 40% of $18,000 to tell us that we want our deferred tax liability to have a credit balance of $186,400. Since it had a balance of zero, to make it $186,400, we're going to have to credit it for $186,400. So let's do that right now. We got income taxes payable. That's the check we're going to write. This is our deferred tax liability, the credit we made this year. This is our deferred tax asset, the debit we made this year. This plus this minus this tells us what our income tax expense should be. So these other things here are balance sheet accounts. This one in red is our income statement account. So what's that look like on our income statement? We've got income before taxes of $412,000. We've got a current liability of $50,000. That's how big a check we have to write. We have a deferred liability, a deferred net liability. This, the bad news, minus the future good news, gives us a deferred tax of $124,000. So our total taxes that should show up on our income statement, not just the check we're going to write in the next couple months, but our deferred tax liability as well, of $174,000. So income before taxes of $412 minus $174,000 in deferred taxes gives us net income of $238,000. The second year is only a little bit more complicated than the first, because we've got to keep our eye on last year's tax deferrals and see if they're reversing themselves out. We have to see if we've created any new ones. And then at the end of the day, we're going to say, well, if we had a certain balance in our deferred tax asset account and we wanted to have this new balance, we must debit or credit it for a certain amount of money. If we want to have a certain balance in our deferred tax liability account, we're going to have to debit or credit it to end up at that desired balance. So second year of operation, sure enough, we predicted that we would receive accounts receivable from our clients. We'd get some cash from them, and that would allow us to book $112,000 worth of gross profit on our tax returns. That happened just like we thought. We entered into some new contracts, but we didn't get paid anything on them this year. So we have $264,000 of gross profit on our books and zero on our taxes. And we think we're going to receive that $64,000 in equal installments. That's $64,000 of gross profit in equal installments over the next 4 years. So that's a new timing difference, a new part of our deferred tax liability. We also continue to use straight line depreciation on our books and accumulated depreciation on our tax return. So that tax liability, that deferred tax liability, is increasing still. It's not starting, it isn't, we'll see on our chart shortly that it isn't starting to reverse out yet. We paid $56,000 on last year's warranty expense, so we'll finally get to deduct that. So we're going to reverse out that deferred tax asset to the tune of $56,000. We're also going to add, because we had sales for this year with some warranty expense. So on our books, we booked $180,000 worth of deferred of estimated warranty liability, but we only paid $50,000 out this year to fix things that we sold this year. So we've got $130,000 of new warranty expenses that we booked on our books but haven't booked on our tax return yet. We also know that we have some tax-exempt municipal bond interest revenue for this year, and it's highly probable that we're going to lose this lawsuit. and we're going to have to pay out in 2022. So since it's a contingent liability that's highly probable, we had to book a lawsuit expense or litigation expense of $172,000 and credit some kind of liability account. But the tax people won't let us do that. We can't take tax deductions for lawsuits we think we're going to lose in the future. Our income before taxes on our income statement was $504,800, and our tax rate going forward is going to be that 40%, just like we said before. But now there's some changes. On our installment contracts from 2013, we're going to start to reverse out some of that deferred tax liability. In other words, we received cash payments from our customers that allowed us on our tax return to book $112,000 worth of gross profit. So we reversed that deferral for $112,000. We've also created $256,000 of new deferral because we had new contracts in 2014 that we're going to collect in future years. Our depreciation expense is still on our tax return greater than on our income statement, so that deferred tax liability is growing still. It doesn't start to reverse out until later. Our warranty expense, remember the facts told us that last year we booked $200,000 and only received $44,000, but this year we actually make some payments on our warranty expense, and we incur new warranty expense for the 2014 sales. Those warranty expenses were on our books for $180,000, but we only made payments of $50,000, so we've deferred $130,000. There's a few more differences too. We have that timing, not the time difference, but the permanent difference of $24,000 because of our municipal bond interest that shows up on our income statement but not on our tax return. And we have a new temporary, just what we needed, another temporary difference, another timing difference. We booked a loss of $172,000 for a lawsuit we think we're going to lose in about 7 or 8 years. The IRS won't let you do that. So we don't get to book anything on our tax return. We've deferred $172,000 worth of deductions until later. Alright, so the facts tell us that we had during 2014 $504,800 worth of income before taxes on our income statement. So now let's figure out what our taxable income should be on our tax return. Well, first of all, we've got to worry about this permanent difference here. We included $24,000 worth of revenue to get to this number on our income statement. So to get to our tax return, we have to subtract it out. We've got some stuff reversing out. That $112,000 is reversing out on the 2013 sales because we got some cash in during 2014. So on our tax return, we had to book the gross profit associated with those sales of $112,000. We also made payments of $56,000 on last year's warranties. So remember, we couldn't take that tax deduction just because we estimated they were going to come in. We had to wait until we actually made the cash payments. Now we've got some more new timing differences. We've got this $256,000 that we're deferring out until we get paid on this year's sales. Our depreciation expense is still larger than our books depreciation expense. So our depreciation expense on our tax return is still larger than our books. So that deferral is growing. And we have $130,000 worth of new deferral of the warranty expense. We booked $180,000, but we only paid $50,000. So we have $130,000 worth of tax deductions to use up going forward. And similarly, with the loss accrual, we booked on our books a loss for a lawsuit we're going to lose in a few years. It's highly probable, so even though it's a contingent liability, GAAP required us to book it, but the IRS says we can't. So we have to add that back in to get to our taxable income for 2014, which is $500,000. Since we're in the 40% tax bracket now for this year, $500,000 times 40% means our income taxes payable is $200,000. Well, what should our balance be in our deferred tax liability account now? Well, it should be this original balance minus 40% of this number that reversed out, plus 40% of this number, the new deferral for our new installment contracts, plus 40% of the depreciation expense on our tax return that is higher than on our books. So when you do that arithmetic, you discover we should have a balance of 277,120. We have a balance of 186,400. To get to a balance of 277,120, that means we would have to credit that account for 90,720 to end up with this desired balance. What about our deferred tax asset? Remember, that's sitting in there at 40% times the 156,000 from last year's warranty expense that we estimated. What should it be at the end of this year? Well, it should be whatever it was here, minus the $56,000 that reversed itself out from last year's warranty, because we finally made those warranty expense payments, plus 40% of the new deferral for the new sales of this year, plus 40% of this deferral for the lawsuit that we think we're going to lose in about 7 or 8 years. So when you do that arithmetic, this minus 40% of the 56,000 that reversed out on the warranty expense, plus the 40% of the 130,000 that we added this year, plus 40% of 172, you discover that our deferred tax asset should have a balance of 160,800. If it had a balance of 62,400, to make it 160,800, it had to have a debit of 98,400. Okay, so let's do our journal entry again. That means to get our deferred tax liability to where we want it to be, we have to credit it for 90,720. To get our deferred tax asset where we want it to be, we have to debit it for 98,400. And that means that our income tax expense on our income statement must be this plus this minus this, or 192,320. What's that look like on our income statement? Well, we're going to have income before taxes on our income statement of 504,800. We have a current income tax liability of 200. That's the check we got to write in a couple months. The deferred taxes is this minus this. The future bad news minus the future good news means that we now have a negative balance in our deferred tax accounts. So our total taxes, current plus deferred, is 192,320. 504,800 minus 192,320 gives us net income of 312,480. So big picture, there's permanent differences between the tax return and our books, and there's timing differences between our tax return and our books. We have to keep track of those timing differences and watch them as they grow, and then watch them as they reverse themselves out. Sometimes those timing differences mean we're going to pay more money in the future. Those are called deferred tax liabilities. And sometimes they mean we're going to pay less taxes in the future. Those are called deferred tax assets. And once we figure out at the end of the year what our deferred tax assets should be, or what our deferred tax liability should be, then we can figure out what the debit or the credit should be to get those balances to where we want them. And that's how we figure out what our income tax expense should be for the year. Alright, that was like way too long and like way too boring, but I hope it was at least somewhat helpful.